have a self-directed IRA and want to do a Roth conversion, you need to watch this. So one of the most popular questions I get from clients is, hey, Adam, I have a self-directed IRA, holds real estate, holds some other assets, and I want to do a conversion. I want to convert, not cash, but I want to convert that asset, i.e. real estate, from a pre-tax IRA to a Roth. And of course, the benefit is once it's in Roth and you're over 59 and a half, the Roth's been open at least 5 years, it's all tax-free. So that's the strategy. People are smart. People want to get their assets from pre-tax to Roth to shelter all the gains. So a few things to consider. Number one, conversion is based off the fair market value of the asset, not what you paid for it, but what it's worth today. So if it's real estate, you're going to want to make sure you get a valuation for that asset. It could be an online source, independent realtor. You don't want to make up the value yourself. You want to have an independent source. Why? Because tax is based off that value. So the custodian, like IRA Financial, will actually require some type of independent verification of the value. You don't have to spend $50,000 from a major accounting firm to get a value, but it's got to be independent. So you need to make sure that you pay tax on the fair market value of the asset. And the IRA custodian will issue a 1099-R based off that value, and you'll pay tax on your income tax return the following year. And the amount of that conversion will just be added to all the other taxable income you have, and then your tax rate will be based off the aggregate amount of all the taxable income. So a couple tips here. Obviously, you want to convert when the asset is depressed in value, right? A lot of people beginning in COVID started thinking about conversions because, hey, real estate's dropped maybe 20, 30%, tenant's not paying rent. I'll get a discounted valuation, pay tax at a lower valuation because I expect the prices to eventually rise. So that's been a really interesting strategy. People have done that with cryptos. When there's a dip in the crypto market and people have faith that that crypto will rise in value, they'll do a valuation at the discounted value. Now, of course, you need to pay tax on that value. So you need to make sure you have the cash to pay the tax. Obviously, consider your age. The lower age you are, younger you are, more value a Roth has than if you're older, more time to appreciate the growth. And thirdly, consider what your income tax bracket will be when you retire. The lower your tax bracket will be, the less value a Roth will have versus someone who's in a high tax bracket. So that's really it. You have to remember, if you're doing a conversion of an in-kind asset like real estate or an LLC interest or a private business interest or a hedge fund interest or even a crypto, you need to get a value of that asset. Cash is easy, right? Convert cash, everyone knows what the value is, it's the cash. But if you're doing an in-kind asset, you need to get an independent source for the asset value so you can then provide that to the custodian. They can issue a 1099-R and you can have a value that you can report on your income tax return. No right or wrong, don't have to do Roth conversions, but if you're doing it, consider those tips. Think about doing it at a discount, at a dip, and of course, make sure you have the tax or the cash to pay the tax.